Is it IBM knocking on my door? Do, go away and don't come back no more. Let's take a look at IBM. We saw it on the old put options scanner, the dividend version. This is the dividend payers daily options scanner, 15% plus annualized return. One of the assets, one of the companies that I saw on here that had my interest was IBM. I looked at IBM here and there from time to time. The one consistent is they typically have very, very low volatility. Well, it is hours away from earnings. So currently, the volatility on their options are pretty high. They're pretty high. Over there on Alpha Spread, they have IBM as undervalued by 16% with a base case of 149.80, and it's currently trading at 126.10, down today 1.3%. So I thought we'd look at it just a moment. Let's take a look at the IBM International with their business machines. This is year to date. Just scrolling through here, they're as high as almost 146 this year and as low as 123.28, and currently trading at 125.88. Is that accurate? Because that's not what Alpha Spread said. Let's roll the dice and take our chances. 125.88 reporting earnings today in 2 hours, just about 2 hours. And I was looking at the volatility on just a short-term trade 2 days out, expiring Friday. What does the action look like? And if we look at the 86% chance of profit, probability of profit, it has a 71% volatility. And if you look out, just say 30 days out on IBM, similar strike price, that was a 119, this is a 120. And look how low can you go? That volatility is under 30%. And that's typically where they are, between 20 and 30% volatility on the IBM. But because of the earnings, and didn't they tell you not to trade around earnings? They did. Oh, apparently I'm not going to listen, because I'm looking at just a short-term fun play on a stock that if we get assigned at 119, we're good. We're good to go on it, because they pay a sweet dividend. They pay that dividend of 5.17%. What does that look like compared to their normal dividends? Is it telling us on the dividend yield theory that it is currently underpriced? So if this number, 5.17, is higher than their 4-year average, then according to dividend yield theory, they are currently underpriced. And if we look at the 4-year average, it's 495, and right now they're at 517. So they're slightly undervalued according to that theory. Now, that's just a theory, right, Bart? Yep, it is. It's just a theory. That is all that it is. And we know IBM to be, they've been around for a long time. In fact, what is the dividend safety with a company like the IBM? Why are there so many red grades like your high school report card? Well, that's rude. You actually clicked on the wrong button. I wanted to see dividend history. Oh, there's our A's. There's my gym class. There's bowling. And if you look here, they have 33 consecutive years of dividend payments with 23 consecutive years of dividend growth. And what I was looking at earlier, if we look down here at the dividends per quarter, you can see that the next declare should be $1.66 on the next dividend. Okay. So they should be announcing their dividend very soon, with the next dividend date in early May and a payout in probably early June. But if we look back through here, okay, so 4 quarters of 163, right? 4 quarters of 164, 4 quarters of 165. You're pretty smart. I'm really not, but I can read. I could read a little bit. So the next one should be $1.66 on the next dividend payout. So we could be involved in that. We don't necessarily think we're going to be. I don't think that IBM is going to blow through 119 in 2 days, but it very well could be based on what they do today with their earnings and how the market reacts to such news. But if we look at 48 cents, right, which is what we would have at the 119, 48 cents divided by the 119 divided by the 2-day trade multiplied by our annualized 365 Fantasyland math, that's 73.6%. That's a lot of percentages, isn't it? That's a lot of percentages. So let's just take a look. Let's take a good look at my face. Should we do a spread? Did you just ask yourself and like get real high pitched? No, that's my falsetto. Let's check on a spread. So what if we went 119 on the sell side, and then on the buy side, we went all the way down here to the 115. We'd create a $32 credit if we continue into that. Say we did 5 of them. Now that's crazy talk. We did 5. How would we fill that? Would it fill at 32? It says high likelihood. Maybe 33. Low likelihood. 32 cents, $160. And that looks pretty good, right? Because that would be $160 on 2,000 in 2 days. Don't even do the math, Bart. I dare you. I double dog dare you not to. I cannot not do it. 160 divided by $2,000 in collateral. And where does that come from? Well, it's $4 wide. Between 119 and 115 is 4 times 100, right? That's 400 times the 5 contracts. That's 2,000. So there's our number, 8% in 2 days. And then we divide it by 2, and then we multiply it. I told you not to do the math. Almost cuss. Do not cuss on this channel. This is a family channel. Why is that making me laugh? I'm so giddy. Like, that trade could go against you, and then it's going to knock your thing in the dirt. $160 bills on a put credit spread from 119 to 115. Review the order. There's our 2,000 collateral. Let's see if we can get it filled at 32 cents. That should fill easy, right? Should fill easy. So let's just try it. Put credit spread, $2,000 collateral, and we've got 0. Can we get 1, 2, 3, 4, 5? Why is it dropping? Might have to go to 31. Might have to go to 31. What's IBM doing as we speak? It's going up, up and away. Why are you doing that? Is somebody watching me? Somebody watching me. Okay, time's ticking, so we got to get back in there and adjust that to get it filled. Let's replace the order. Continue. What can we do? Can we do a 31? We should be able to do a 31, right? Come on now. Just do the 30 and get it over with. $150. Okay, quickly, get it going. 150 on 2,000. We're still going to be in Fantasyland math. All right, that's filled. Let's do the math again. 150 divided by 2,000. That equals 7.5%, but we would divide that by 2, carry the 1, multiply by the abacus, 365. And that is just way more math than I even know what is. That is a big return, which also means because of that volatility, that's also a big risk. Indeed, it is a big risk, and we have just taken it on. So we'll keep an eye on that trade. It's either going to go really well or really bad fast, because there's not much time left in that trade because it is 2 days out and they have their earnings in 2 hours. 2 hours, 2 hours. Their earnings are in the way. But the other side, if IBM keeps ticking up right now, okay, let's go to the chart with the 1 day, 1 minute candles. Go get those candles going on the 1 minute. So if it keeps trying to go up on the chart here, then we're going to be seeing this trade chains right before our very eyes, because right now it's showing that down $6 bills. All right. So what else do we have here on the board that looks interesting? I see a lot of negative numbers, Bart. Well, but those are calls. And again, we're going to allow some of these to be called away if indeed that's the case. Did Philip Morris go over 102? Philip Morris is knocking on $102 door. Yeah, yeah, that's okay. That's all right, mama, because we're at 92 and change on our cost basis, and they could take it, and I'll just write a check to Uncle Sam. I'm happy with that. Paying taxes means you're making dollar bills, right, Bart? That's right. It is. So there we go. That's a little IBM action. I'll check back soon. Got some other ideas brewing in that buzzy pea brain of mine, and I'll share those with you. But make sure you do indeed subscribe, like, comment. Make it a lovable comment. Why are you whispering? I don't know, in case they got their earbuds in. I don't want to blow their ears out. So there we have it. See you in the next video.